panel. But hold on a second. I don't get to the panel. Bring on the Nigeria's IMF deal. And that's what I was looking for. Thank you. That's the IMF refinancing facility that Nigeria took from the IMF on a request for that nearly 100% quota of Nigeria's special drawing rights with the IMF back in April 2020 when COVID-19 broke and Nigeria saw its finances down on all fours. That was a 5-year loan. Of course, it has a 3-year moratorium. The repayment period was 2 years. The government has paid or kept what you call faith with the repayment. So what has happened was that from July of 2023 until April last month, Nigeria has fully redeemed the $3.4 billion US dollars. In SDR, that's about $2.45 billion. If you convert that to real currency, that's $3.4 billion in figure. The total repayment installment was 8. It was done on a quarterly basis at about $306.8 million US dollars. Sources say the final payment was made last month by the Ministry of Finance and the Central Bank on behalf of the Nigerian government, and that was $415.603 million US dollars. As of today, Nigeria has no debt obligation to the International Monetary Fund. Let's move on. A panel of 6 international experts in finance, investment markets, and the economy were put together by the Milken Institute on Tuesday. The idea was to discuss the state of the global capital market within the wider context of the ongoing global economic turbulence. Let's take some excerpts.
It's certainly been a fluid few weeks, and there's been a lot that's been coming at us pretty hard and fast in terms of announcements and changes. But I think we've got to recognize that this is going to play out slow. We've got to keep a perspective and be very mindful about what the longer term looks like amidst all the announcements. So if we break it down, if we look at just the tariffs, I think we're going to see 3 different phases that are coming through from this. The first is the one we're seeing right now, where we're seeing the pull forward of some of the spending from the consumers and from corporates. And we've certainly seen that in the April data. The hard data has been reasonably robust. Then you have the second phase that's coming through, which is going to be the fact that most companies are a bit in limbo land. There's a wait and see going on at the moment, where everyone sees how this will all play through. And in that, investment spending, some of that's been suspended. Some of the decisions on CapEx or on hiring has also been on hold. And that will have an impact on demand in the economy. And then finally, we'll find out exactly where the tariffs come into play. And in that, we'll have an impact on supply as well as on pricing. And as all of these different pieces come together, I think one of the big questions for all of us in the room is going to be, what is the magnitude of the tariffs? Because if it's 10%, most of the clients we talk to say, yeah, we can absorb that. If it's 25%, not so much, or higher than that, and that's going to catalyze a very different set of dynamics. So at the moment, it's worthwhile sitting there, observing what's going on calmly, but being very mindful about what the long term is going to be, and looking for the indicators of how that plays out. That's what we're seeing most of our clients.
But we are a long-term investor, and we've been allocating capital for a long time. Our horizons are generally not less than 7 or 8 or 10 years, and we've held investments for more than 20, especially those that we like and that keep generating the types of returns that we like. And so I think the word that I would use to describe what we're looking at today is deliberative. We're looking, we're assessing, we're figuring things out. We haven't stopped deploying capital because at the end of the day, I still believe that the U.S. is still the best risk reward, globally speaking, after having looked at the world. I do think that there might be a little bit more friction in terms of doing business, but I think that's going to be more of a short-term phenomenon as things settle down over time, as clarity and the new normal becomes more evident. And, for those of you that don't know, 42% of our portfolio is in the United States. So today, Mubadala is a $330 billion asset manager, and so that's over $100 billion that's here. I don't foresee that changing. Most of, I think, the best companies in the world are here in the US, and I think we're still going to keep investing in them. So since that general equation hasn't changed, I think right now we're just gonna just watch and see what other kind of interesting developments happen.
Interesting developments. Well, we heard the Treasury Secretary. I'm curious, though, in terms of that deploying that capital here, does it change at all your strategy in terms of either sectors or the way you're thinking about different asset classes?
So all the sectors that we look at, we essentially look at a 3 to 5 year perspective. And so, like I said, we're deliberative. So what that means is every year we will sit down and decide what the big themes are going to be for the upcoming year. Remember what Mubadala is, David, and I think I'll just describe it for a few minutes for those that don't know us well. Mubadala is really three things. So first is the part that most of you know about, which is the direct investor. So we are like a private equity firm. And that is not just direct investments in private equity and non-listed companies, but it's also a large private credit business. It's also a real estate and infrastructure business. And so that together is a big part of Mubadala's portfolio. But Mubadala also has an endowment portfolio. So what I call our endowment portfolio, think Stanford or Harvard or MIT. And so we allocate capital to managers to obviously maximize medium to long-term return in that way. And we're quite competitive. And then the third part of Mubadala that people know less well is our GP-led business. So most of the time people think of us as capital allocators. But the truth is, in our GP-led businesses, and we have two at the moment, we're the managers. Mubadala Capital, which is a up-and-coming alternative asset manager headquartered in Abu Dhabi, and MGX, which is our tip of the spear from an AI and technology investing perspective.
So I'm the new kid on the block 1 month in, so it's been an interesting month to say the least. My perspective is obviously policy uncertainty is driving volatility, but I'm more focused on how that does impact both our institutional customers and our end consumers. And, we're seeing evidence of slowing down. We're seeing the level of investment, the hiring, coming to a slowdown, the number of transactions. Probably the best example we've seen is in our real estate business. Obviously, real estate went through a trough, and we were coming out the other side and seeing the market really pick up. But I will say, given the level of uncertainty in March and April, we definitely saw fundings pulling back a bit and transactions slowing down a bit. So, I think the sooner that we could get the policy certainty, I think it'll be better for the economy.
I think it's worth taking a step back for a second. I generally agree with what people have said on the panel. I think when we came into the year, David, there was this extraordinarily high expectation and momentum, and everything was sort of pro-growth. And I think with the tariff policy, people were just left a bit confused and uncertain because it felt like such a shift dramatically in policy. And, at times, this was compared to other financial stress periods, 2008, 2000, 94, 87. I think this is wholly different. I think there's moments where the market seemed a little bit fragile, but if you look today, the S&P is down a couple of percent. And so I think this is wholly different because this is a policy initiative that we've never seen. I actually thought the Treasury Secretary's articulation of how the administration is looking at this was actually one of the best I've heard, personally, in terms of how they think all this will knit together. But I will say, so at Carlyle, we're about $450 billion plus in assets. We have 23 employees, but we have 700,000 employees in portfolio companies around the world. And what's happened there, and I think that's where we get our best information because we have these proprietary KPIs, is at the ground level, it's very tactical and hyper-strategic right now. So if you're in an industry that was, let's say, highly impacted by tariff, then it doesn't necessarily mean that you stop importing, you shut down, you immediately move to a conservative posture. It really is about what's your relative competitive position. So if you have scale, if you have financial flexibility, you may choose, actually, even though if you're in a tariff-impacted part of the market, you may choose to lean in and be very competitive and buy market share. If you're more financially fragile, so what we're seeing on sort of the portfolio side is definitively a lean towards protecting capital, making sure there's maximum financial flexibility, not because people think we won't get to the other side of this, but it's a question of how long. And so how do you manage inventory? How do you manage your client relationships? But people aren't disrupting client relationships immediately. They want to make sure they protect those. And so I would say it's very much a period of uncertainty and wait and see. The flip side, I would say, I probably talked to more CEOs and more CIOs in the past 2 months, maybe in my entire life. I would say virtually all of them have finished the conversation with, hey, don't forget about us, we're open for business. We're not looking to rush to deploy capital, very similar to what Lee was saying. There's a hesitation. The risk premium is definitely higher, but people want to engage and they want to put capital to work. And at Carlyle, for example, we have over 80 billion of dry powder. So we are actively looking for opportunities, but again, risk premium's higher because uncertainty is higher.
Right.
I think I completely agree with Harvey on the administration's doing a better job at articulating kind of what the plan is, right? You heard it. It's the interactive engine, trade, tariffs, and deregulation. I think that it is what we need to see is, well, let me step back for a second. One of the challenges of the U.S. geopolitical system is when you're elected as a president, you have about 2 years, really 18 months to get your legislation through. Because the midterms come, it flips, and you don't have control of the Congress any longer. And so what feels like chaos is really a push to get a lot done in a very short amount of time. And so, and that's a little bit scary to people, but if you think about it, right, first of all, the tax cuts are not tax cuts. They're an extension of existing tax plans, but they have to be funded. So how do you fund them? Well, ideally, you fund them by cutting some government spending. We're on an unsustainable path as far as the deficits. And that's hard to do, really hard to do in a 2-year period. The other way to do it is you fund it with things like tariffs, so tax increases. And so you go out and you say, and by the way, President Trump said this tariffs will generate $600 billion in tax revenues. Now, whether the CBO prices it that way, he needs about $400 to $450 billion a year to fund the tax extensions, right? So it's a great way wherever that comes out. So he can't cut too many deals until he gets the tax legislation through. And so I think that those two things, now that they're articulating, are interconnected is really important. And so what do we need to see? The market would like to see a couple of deals cut, right? To know that the U.S. really intends to play ball. So I think that's important. The second thing is we need to see meaningful progress on the extension of the tax cuts or the existing tax system with a couple of additional cuts in there. And if you get those two things, I think it's going to calm the market a lot. And I think that's what folks are looking for.